Let's start with the digital versus real divide. Banks create deposits electronically when issuing loans. However, you repay this system entry with real hours of your life, stress, and labor. The creation method is electronic entry, but your cost is real labor hours, claiming your future labor. This is the most shocking part you never realized. Welcome to Lesson 0, the mortgage trap nobody warned you about. This lesson is here to do one thing: help you see your mortgage differently. Not as a normal monthly bill, but as a long-term claim on your future time, income, and freedom. Let me start with a scene that happens every day. A family gets the keys to their new home. Everyone smiles, everyone celebrates. Everybody says, "You made it." But what most people do not realize is that the most expensive part often starts after the celebration. Because a mortgage is not just a way to buy a house, it is a long-term system. And if you do not understand that system, it can quietly redirect years of your life into interest. That is why so many people keep paying and still do not feel free. In fact, even the word itself should make people pause. The word mortgage comes from Old French and literally means dead pledge. That is not drama. That is the original meaning of the word. The pledge dies when the debt is repaid, or the property is lost if payment fails. Now, here is the second shock. Most people imagine banks lending money like a relative lending cash from a wallet. But in the modern economy, banks create most money when they make loans. A loan creates a matching deposit electronically in the system, and that means something important. The loan can be created quickly, but repayment comes from your real life. The bank creates the loan electronically. You repay it with years of your labor, with your mornings, your evenings, your discipline, your overtime, and your stress. That is why I want you to stop seeing a mortgage only as debt and start seeing it as a timeline. Now let us talk about why the early years feel so frustrating. At the beginning of an amortized mortgage, most of your payment usually goes to interest. Only a smaller portion reduces the principal. So yes, you are paying, but no, that does not always mean you are getting free quickly. That is the emotional trap. People think payment means progress. Sometimes it just means survival. You stay disciplined, keep making payments, and still feel like the balance is not moving the way you expected. Now, let us make it real. On a $200,000 mortgage at 6% over 30 years, the monthly payment is about $1,199. But the real crunch is the total interest, about $231,676. That is the hidden life cost most people never convert into human terms. If you earn $20 an hour, that interest alone equals about 11,584 hours of work. That is around 290 full-time work weeks, or about 5.6 full-time working years. Not for the house, not for the walls, not for the roof, just for interest. And the trap scales fast. A $300,000 mortgage at 6% over 30 years creates about $467,279 in interest. At $30 an hour, that is about 7.5 work years. This is why bigger mortgages quietly become bigger life transfers. So the wrong question is, can I manage this monthly payment? That is survival thinking. The better question is, how many years of my life will this mortgage cost me? That question changes everything. The first real shift is identity. Stop thinking only like a borrower who wants approval. Start thinking like an owner who wants freedom faster. The goal is not only to carry the mortgage, the goal is to end it sooner. Why does faster payoff matter so much? Because the quicker you reduce principal, the less future interest you pay. That means every smart move that attacks the principal can give you more of your life back. The bank's default schedule is not the only path. In fact, even small changes can matter a lot. Wells Fargo shows that on a $200,000 30-year mortgage at 4%, paying $100 extra each month can cut more than 4.5 years and save over $26,500 in interest. Paying $200 extra each month can cut more than 8 years and save over $44,000 in interest. That should tell you something important. Speed matters. And this is only the beginning. In the next lesson, I will show you the numbers banks show you versus the numbers you actually need to watch. Because once you see the right numbers, you stop guessing. And when you stop guessing, you stop giving away years you never meant to lose.